Good morning and welcome to Money Control live stream. You're watching Markets with Santo and CJ. Well, it's more like Santo and Mango this morning because with me on the show is Mangalam Maloo, analyst and anchor at CNBC TV 18. Well, Mangalam tracks all things consumer and especially keeps a hawk eye on the developments in the retail, quick service restaurant space and also building products. Besides all this, he also has time to track the logistics sector. Well, Mangalam was kind enough to take a break from his regular routine at CNBC and stand in for CJ, who's a bit under the weather this morning.
First up, you don't have to say I was kind enough to take a break, etc. I was just raring to get out of a shirt and get into a t-shirt and feel a lot more younger than I am, maybe.
That's nice to hear. Well, CJ, as I said, CJ is under the weather, and CJ, in case you're watching the show, which I suspect you would be, get well soon, and don't worry, I won't be trying to convert your followers to follow my worldview of the market and stocks like you did the last time.
Well, and in case you are watching this, maybe just trying to say that I'll try to do as well as you do, all right?
Well, and before I pick Mangalam's thoughts on the major earnings in the FMCG sector and also the stocks that have been in the limelight, let's take a quick look at the market setup. Well, the US GDP has contracted for the second quarter in a row, but the stock market does not seem to be taking any notice of it. Most US equities ended higher. Now, gold is firming up as the market is now betting that probably the Fed might go slow on its pace of rate hikes, and back home also the sentiment is quite upbeat. SGX is pointing towards an open of about 17,000. It's up about 200 points at this point. Mangalam, first up, a dramatic change in sentiment over the last few days. And what are the indicators from the FNO segment? We have already seen some bit of buying in the cash segment by FIIs yesterday. What about the FNO segment?
A dramatic change indeed. And you said that US shares have rallied despite the economy contracting. Well, that's exactly the reason why the markets moved higher, because every time the economy contracts, they believe that the Fed is going to give a lot more largesse. And that is something that the FIIs were positioning themselves for as well. If you just take a look at it, 6 out of 10 FII positions at the start of the August series, remember yesterday was July series expiry, is on the long side. So you have 57% long exposure. This at the start of July was just around 15%. So that's telling you that 85% of the FIIs actually believed that the market will fall. And guess what the market did? In July series, we saw a rally of almost 1150 odd points. So those are a couple of things that really stand out from the FNO pack. 2/3 of the FII holding, or rather 3/4 of the FII holdings and the market holdings have been rolled over from July into August. So a lot of their belief is that maybe the momentum that we saw in July will continue into August.
Well, thanks for that, Mangalam. And now let's take a look at some of the stocks.
Yes.
Let me pick your thoughts. Now, FMCG stocks, generally till about 2 months back, the widely held view was that inflationary environment is always bad news for FMCG. Besides that, you also had FMCG stocks at expensive valuation, but things have not exactly played out that way.
Things have not exactly played out that way because the market always looks ahead. What is the market looking at? When global central banks are increasing their interest rates, governments are looking at taming inflation. Everyone believes that maybe, this is the top that we're looking at in terms of inflation. The companies have already taken price hikes, so margin should only benefit from here. And you and I know as consumers that, if something becomes expensive, it never becomes cheaper once again, right? They'll at best give you 20 grams extra or something of that sort. So the price point that has been established now is there. So that bodes well for the margins. Third thing that took place was the underperformance of the FMCG space in the last 2 years meant that the valuations which were extremely expensive have now just become expensive. And the fourth most important thing is that when everyone goes to every place, loses some money in that place, comes back to FMCG as a safe haven. Metal stocks were falling. We had the banking stocks which were falling. We had the IT stocks which were falling. So where do you find solace? FMCG.
Well, that should tell you why FMCG stocks have been doing well despite expectation that they would underperform. Now let's get on to specific stocks. Mango, starting with Jubilant Foodworks and also Westlife. Both companies reported a strong set of numbers. What do you read into them?
How often did you order pizza or burger in the last 3 months?
Not very often, I would say.
You are not their target audience anyway. It's people like
you are
me.
More like it,
yes.
Yeah.
So, for Jubilant Foodworks, it was a good set because 28% like-for-like growth. Okay, you can quibble about some growth and all of that and stuff coming here. What you can't quibble about is that they are opening stores at a random pace. So they, I mean, at a frenetic pace. They have 58 Domino's stores that they've opened in the first quarter. They've guided for 250 Domino's stores being opened. And when do companies do that? When they see demand going ahead, when they see that, you know, people will go ahead and buy their pizzas, etc. And then you have all the other companies of the world saying that they will do quick delivery, quick delivery, quick delivery. Here's Domino's, which has actually said in the conference call that 70% plus of their orders have been delivered in less than 20 minutes. Their guarantee is 30 minutes. They've delivered it less than 20 minutes. And in doing so, they've remained profitable. They've kept their margins at around 25%. So that's real Q-commerce, as against, you know, what a lot of people say, that you will overinvest, you will burn, you will lose a lot of money and send something out in just 10 minutes. So that's good.
So in the case of Jubilant, you know, when they started the strategy of opening stores very close to each other, there was a fear that it would cannibalize. Are we seeing any kind of impact on that so far?
We see that. We definitely see that, because same store sales growth, if you know, look at the number of stores that have increased over the last 3 years, and if you look at the actual sales that has increased and the price increase that a company has taken, it would imply that maybe the same store sales growth have come down. Stores have cannibalized, and which is why the reason the company stopped giving same store sales growth in its release. Now it gives like for like growth. What does this mean? Simple. There is a big Domino's store here. Across the road, they you know, open another Domino's store, and that's 2 Domino's stores, because they can then you know, deliver products in less than 20 minutes. There's one way, etc., and all of that. So by these stores being split, it's not that, you know, both of them will have the same revenue. It's this store which gets 100, and this store you know, comes again. So say, assume the revenue is split 50-50, and then on that it grows about 10%, 55-55. For this store, the SSSG would be down 45%, whereas for this one it will be up 10%. But on a like-to-like basis, the overall system sales have grown by 10%. So that's like-for-like growth. That's what they refer.
Okay, so coming to Westlife development, you know, this stock has done better than Jubilant Foodwork, though Jubilant Foodwork is more of the high-profile stock in the QSR space. What possibly explains this shift in sentiment a bit?
A couple of things. You know, the biggest thing that I discovered over the pandemic was that a lot of people said that pizzas are for home delivery and burgers are for eating in restaurants, because burgers don't travel well. By the time a burger comes to you, maybe it becomes, you know, the bun breaks, etc., and all of that. But people have worked on that. They've made burgers more home delivery friendly, and now you see burgers being delivered more than pizzas in recent times. And that is what is taking place. In Westlife, McDonald's has always promoted itself as a family restaurant apart from delivery. So delivery has done well for them during the pandemic, because people had no options. And now dine-in has come back. So together, what has happened is that earlier they've suddenly discovered an engine which was not there. Even now, as we speak, dine-in has come back. It accounts for 58% of their sales, and convenience, which is taking a burger away or ordering it in, etc., is now 42%. So that's just telling you that the company has grown their sales, and they've also launched a lot of new products. I mean, you should order a lot more. You should try some of their gourmet burger collections, etc. So you know, it's doing well for them, and they're opening restaurants as well. They're on track to open, what, 200 restaurants over the next few years.
So what does that mean probably for someone like a Jubilant? Now, just purely going by price performance at this stage, it seems to suggest that probably investors are more hopeful about Westlife development than they are about Jubilant at this stage.
It looks like investors are betting that Jubilant will grow faster, Westlife will grow faster, primarily because they've shown numbers. The unknown in Jubilant Foodworks right now is that the new CEO, Samir Khetarpal, takes over from September 5. Now, Samir is an Amazon veteran. He's been there for about 6.5, 7 years. He's got FMCG experience for about 25 years. He's the one who started the Amazon Fresh, etc. So, does Jubilant now look at itself as, you know, a company which is more food tech than just food? And secondly, while Domino's is doing well, the other engine of growth for them is Popeyes. They've guided for 20 to 30 restaurants being added on Popeyes. And if that does well, because globally, the chicken sandwich, I'm a vegetarian, so I wouldn't know much. That segment is doing extremely well. You travel abroad, you will see Popeyes, Chick-fil-A, or any of those chicken sandwich companies. They see a lot of crowds outside. There is some you know, traction for them.
And what about Nestle's earning, Mangalam? The stock again has been an underperformer of sorts this year. It's been flattish. So will this the latest set of numbers kind of change the fortunes for the stock?
Well, let's not look at the numbers this time around, because what happened beyond the numbers was a lot more. And the most important thing was they took in Purina, which was the parent company's product, into their own fold by paying about 120 crore rupees for that. what does Purina do? It is a pet care brand, and it's one of the best pet care food products that we have right now. 36 crore is the revenue that they do, but the pet care market in India is 4,000 crores. Little did we know that it would grow so fast, and it's growing at over 25% CAGR. So they've suddenly unleashed a new category, an opportunity where they can take the Purina brand and pump it into the Nestle distribution and suddenly scale it up.
So how does Nestle now, let's say, compared to say its peers? So for instance, like a Britannia.
Nestle is always traded at a premium to the entire FMCG space. Britannia would not be the exact correct comparison. Maybe, you can say, yeah, the food business, etc. and all. But Nestle is now looking at newer opportunities. So the Gerber product that they launched for infants, etc., that is premiumizing. The average cost of Maggi, say if it's 100, the price of Gerber is 700, and they are targeting those segments. They have a big product pipeline which is in the international fold, which they will get to India as India moves faster and as India grows, as the market grows. So I think it's raw material prices are likely to cool off. We all know that. Nestle is likely to grow in the urban pace, which is its stronghold. And now they're increasing their focus in the rural India as well. Rural for Nestle has done much better than what it's done for HUL or Dabur or any of the other companies. So they have a lot of engines firing for them.
So Nestle, one of the quibbles against the stock is that already it's very expensive. So do you think investors now will be willing to pay a higher premium for this stock?
Well, it was very expensive 2 years ago. It underperformed for 2 years. So you can say there is some time correction. And with new engines of growth coming in, maybe the incremental value add should be there.
Okay, now let's talk about a stock which is, people probably love to bash at this point in time, and that's Zomato. The stock has taken quite a bit of pounding this week so far, falling as low as 40 rupees.
Yeah.
Now, Mangalam, what is the trigger now here on going to be? It's a well-known fact that the company won't be making profit for some time to come. That's pretty documented. So is it that the overhang of excess shares coming into the market, is that going to play a dominant factor, and if so, should investors be looking at it as an opportunity?
That will be a trigger, important trigger, and investors can't be timing that opportunity. If they're looking at that opportunity, then they have to wait for the prices to settle, because there are a lot of sellers right now. The biggest of them perhaps could be someone like an Uber, who got that 8% stake while, when Zomato acquired Uber Eats from them. 8% stake for Uber, whenever that comes into the market, will be a big supply overhang as well. So let's see what happens to that supply. You just have to daily, monitor the way the price moves and the volumes move. Once you see it is settled in, there is, some on the street who are saying that there have been some bull cases for them, because from a market cap of over 1,40,000, now it's sub 40,000, closer to 30,000 crore in terms of market cap. They still have cash of 12,000 crores on their books. So cash is roughly, 1/3 of their market cap. So that is some bit of margin of safety. The EBITDA loss in the month of May was around 110 odd crores. Expect that this 100 crore run rate continues. That's 1,200 crore of EBITDA loss per year. The cash that you have is 12,000 crores. So that still gives you enough runway to be in this business without raising capital for the next 10 years. Is that going to be your view? Well, if that is, then maybe this is a decent time. But then again, you are standing against a lot of supply of shares. So it can go lower from here as well. So if you're prepared for that, maybe, then yes.
Fundamentally, what are the other worries as far as Zomato is concerned?
The biggest worry for Zomato right now is the capital allocation. Second, stagnating monthly transacting users. The third important worry is that now people are eating out, right? So there won't be as much ordering in. Those who are eating out will obviously run higher average order values. And finally, an outlier could be ONDC, which is the the government-led open network for digital commerce. If that comes by, then that could be an unknown competitor to Zomato and all the other restaurant companies, because every restaurant will then go on ONDC platform itself as against Zomato.
Well, let's take a quick look at the market. The Nifty has opened above 17,000. The Sensex is also up close to 0.7%. Firm start there. So, Mangalam, what does it look like?
What does it look like? Right now we are above the 200-day moving average on the Nifty. 17,033 is the 200-day moving average. Do we sustain above this or not is the big question. It's day one of a new series. We do have a lot of triggers as well. 5th August is the RBI policy. So does the market sustain around these levels or not after having a big rally is something that we'll have to watch out for. Fear of heights is something that it may be facing right now. Let's see where it goes.
The last stock on our watch list this morning is ITC, clearly an outperformer in the FMCG, not just in the FMCG pack, but also across most sectors.
It's among the top performing Nifty stocks in this year, and by virtue of having done nothing, it hasn't fallen as much as the others.
So besides valuation, what is going to be the next major trigger for this stock?
They have their results on Monday, and that will be a big trigger because the street is expecting the cigarette volumes to grow by 25 to 26%. And for ITC, no matter what you call it, as an FMCG company, a hotel company, whatever, money still comes in from cigarette. 90% of their EBIT still comes in from cigarette. So if the cigarette business does well, ITC has to do well. That is doing well right now because the regulatory environment is favorable for the last couple of years. The next big trigger is as things are opening up, the management here on CNBC TV 18 had said to us that, they are looking at hotels demerger. In fact, that's back on the table after having taken it off the table. So once they do any sort of value unlocking there, could be a big positive for them too.
Well, thanks for all those insights, Mangalam. And with that, it's a wrap on this edition of Markets with Santo and CJ, or shall we say
Santo and Mango.
Well, please do share your feedback in the comment section below, and we'll be back again at 3 p.m.